Recording this today, so if anybody at the end would like the recorded version, just let us know and we'll have Natalie email that to you. Now you guys can see my screen with the PowerPoint presentation and not the GoToMeeting icon, correct?
Yes, correct.
Okay, I just want to make sure there's nothing distracting. So the agenda for today is I'm going to run through some information on the credit bureaus, credit scores, errors in credit reporting, tactics for raising the score quickly. We'll talk about student loans real quick as it pertains to mortgages and how it affects you guys. And then, of course, I'll make time for questions. Any questions you guys have, I'll make sure we get answered by the time we get off the phone, okay? There we go. Now it's working. So first, I'll start with the credit bureaus. I think most of you guys know there's 3 credit bureaus in the U.S., Experian, Equifax, and TransUnion. But what a lot of people don't understand about the credit bureaus is what their function is exactly. A lot of consumers, especially consumers, think that the credit bureaus are somehow affiliated with the government. They got pretty official sounding names. They have the word bureau or agency attached to them. And a lot of times that can elicit feelings of being associated with the government. But what I want you guys to know is that the credit bureaus are not affiliated with the government in any way. They're they're private for-profit companies, billion-dollar companies, just like Coca-Cola or Home Depot or anybody else. Another big misconception amongst consumers is that they're consumer-friendly organizations. I don't know why. We know that's not the case, but there's not a whole host of services and products that we want to consume from the credit bureaus. It's not easy as a consumer to get on the phone with them or deal with them or get a question about credit answered. And at the end of the day, the credit bureaus really are not consumer-driven organizations. They don't really care about the consumer as an individual or how their information is being reported to the credit bureaus and whether it's accurate or not. And the reason for that is that's not how they make their money. The credit bureaus make their money by buying and reselling people's personal information. They buy and resell all of our personal information on a daily basis. And, you know, they would sell it to, say, mortgage companies, insurance companies, credit card companies, and banks, anybody who wants to buy that information and make offers or extensions of credit offers to consumers. So one of the things that we like to talk about and I want to make you guys aware of is opt-out. I'm not sure how many of you have heard of opt-out, but as a mortgage loan officer, if somebody comes and applies for a mortgage loan with you or a refinance and you pull their credit, it's very often that consumer will start getting lots of calls from other mortgage companies. And I think you guys know those are called trigger leads. And all the unsolicited mail and credit card offers and the things that come in the mailbox, same thing. All that information is coming because the bureaus are buying and reselling your information on a daily basis. What most people don't know is there's a way to end that. Just like you could opt out from telemarketing call list or other lists. And now I know the telemarketing one doesn't work very well, especially with cell phones, but this works. And I have a website here on the screen. You can see it on this slide called optoutprescreen.com. If you have not done this personally, I would do this personally for your own good. But if you are talking to consumers or other people, friends and family that you know, this is a good piece of information to put out there. You could put it out there in a newsletter or on a social media post or a blog. But this is information you want to get out there because if you go to this website, the optoutprescreen.com, you as an individual can opt out from the credit bureaus, which means they can no longer buy and resell your information ever again. And that serves a couple different purposes. One, the less your information is bought and resold, the less likely bad things are to happen, like your information being exposed in a data breach or identity theft or other errors on your credit. So the less it's out there, the less exposure you have. The other purpose it serves is kind of protecting the integrity of your lead. If you're a mortgage person and you're pulling somebody's credit and you know that may put them in kind of a funnel for trigger leads, or especially early in the process when you're dealing with consumers, if you can get them to opt out, the less likely they are to be bothered by their mortgage companies and your competition stepping in and calling your leads because they were sold off as a trigger lead, okay? The way this works is if I'm Capital One or I'm ABC Mortgage Company, I can have a standing order with the Bureau that says, I want everybody that lives in this zip code, and this zip code who's applied for a mortgage in the last 90 days, or who has a credit score between this and that and meets this criteria, this criteria, and this criteria. And if you're on that list, you're going to get called, or you're going to get the unsolicited offers in the mail. So when you opt out and from the 3 credit bureaus here, and they can no longer buy and resell your personal information, that means your junk mail will dry up, and a lot of the pre-screen offers will go away. Okay, I have a bullet point on here about credit monitoring, and this is particularly relevant to loan officers because it's very common for consumers to come your way and you ask them how their credit is, and they say to you, oh, my credit's pretty good, and I checked it online. Or, yeah, I've got a 720. It's not bad. And you may ask them where they saw that credit score, and oftentimes they're going to tell you what? I saw it at Credit Karma. I saw it at this online monitoring site. I saw it at my Wells Fargo, provides me a copy once a month. This is particularly important because I want you guys to understand that consumers are 2 levels away from a mortgage score. So what you're looking at versus what they're looking at is not only the difference between a FICO score and an online credit monitoring service, which is not a lender-based score. We call it a FACO score. Okay, it's not FICO, it's FACO. And it's a FACO score because it's a consumer-driven score that has nothing to do with lending. And so it doesn't matter if it's Credit Karma or any of these other online credit monitoring websites, they're selling and pushing out consumer-based scores. 95% of all lending decisions in the U.S. are based off FICO scores, and 100% of mortgage lending decisions are made on FICO scores. So it causes a lot of confusion when you're dealing with borrowers who saw online that they had a 690 and you pull their credit and they're a 620, right? The average difference between a Credit Karma score and a mortgage score is about 60 to 80 points. So they're 2 levels away. One level is they're seeing a consumer-based score online that has nothing to do with lending, and they're another level away from a mortgage score because even if they do get a FICO score, let's say they get a FICO score from their bank or credit card company, it's not a mortgage FICO score, and a mortgage FICO score is a lot different than an auto FICO score, which is different than a credit card FICO score. It's really important for you guys to know that we all have many different versions of a FICO score, and it's only based on what you are applying for that a particular score is generated. So if I was to go apply for a car, a house, and a credit card today, I may get 3 vastly different scores because they all work under different FICO scoring models. That makes sense? So moving on, let's talk about FACO score versus FICO scores. And we talked about the consumer confusion already with Credit Karma and a lot of these online monitoring sites. When you go to FICO, there's actually a website called myfico.com. I've got it listed at the bottom of this particular slide. Myfico.com is the only place a consumer or you as an individual can go without having a hard hit on your credit and seeing what your actual credit score is, okay? And the beauty about this is, FICO is the one that developed the scoring formulas. FICO went to the credit bureaus 40 years ago and said, hey, I got an idea. Let's grade all that information that you guys store in these big databases and sell it to lenders for risk analysis. That's how credit scoring came about. And MyFICO sees the bureaus and these credit monitoring sites pushing out consumer scores, fake scores that confuse the consumer, don't have anything to do with lending. And I think and FICO says, hey, if they can make $8 billion a year selling fake credit scores, how much can we make, given access to consumers to the real credit score for their real credit scores? And that's what they did. They came up with a consumer access website. It's called myfico.com. And there you can go see your real FICO score, and not just one, you can see all versions. So you can see your auto score, your mortgage score, your credit card score, your bank score, and they'll be different, but they're all real credit scores. And so if you're speaking with a consumer and they need to know exactly what their credit score is, and you haven't pulled it, or they don't want you to pull it, or they're not sure, they can always go to MyFICO. And if it says at MyFICO that their mortgage score is a 675, when you pull it, it's going to be a 675. It's point for point. It's the real deal. Okay. So MyFICO is a little more expensive than some of these other credit monitoring websites, but they're going to get the real score and they're going to have an accurate reading of exactly where they stand. Okay. Now, as far as you guys in the mortgage industry, these are the current versions of score that each bureau is using. Okay. So you see Experian version 2, TransUnion version 4, and Equifax version 5. And that's why consumers will come to you and say, hey, I just bought a car last week and my score was a 650. And maybe it's only a 610 on mortgage. And the reason is the newer scoring formulas, FICO 8, FICO 9, that the auto and credit card industry are using are much newer and much more lenient than the mortgage scoring formula. The mortgage scoring formula that you guys use is 20 years old. It was last updated in 1999. So version 2, 4, and 5, these versions that Experian, TransUnion, Equifax are using for mortgages for you guys is 20 years old, and it's the harshest scoring formula out there. That's why for most consumers, their mortgage score is going to be lower than their other scores. It is the harshest scoring system. The mortgage scoring system is extremely penal. That's why one medical bill can drop your score 50 points. One late mortgage payment can drop your score 100 points because it's an old, very strict version of the FICO scoring formula. Now, a lot of mortgage people always ask me, hey, when are we going to move to a new scoring formula that's more lenient? Well, if you look here on this slide, I have FICO 9. This is the latest version of FICO. It's already being used in the auto industry and credit card industry. Not mortgage. You guys are using the old one. The average difference in score on FICO 9 versus a mortgage score is 30 to 40 points. That means every consumer across the nation, if you take an average 30 to 40 points higher than the mortgage scoring formula. And it is a more forgiving scoring formula, but it is also more predictive, or they wouldn't be using it. So it can predict risk and default rate at a higher level than the older versions and still produce a higher credit score. Okay. And so the question always is, hey, when are we going to move to that new scoring formula? Because we'll have more borrowers that are qualified. And that is true. When you guys do move to the new scoring formula, you will probably have more borrowers qualified. It's less harsh. This new scoring formula is less harsh on medical bills. It devalues them, unlike the old scoring formula. It's less harsh in the singular instance of late payment. And it's less harsh on thin files. So people can build a credit score quickly and get it higher than in the old scoring formula where it takes 6 months plus to just report a score. Okay, right now it's business as usual for the time being. The mortgage industry will not be moving to FICO 9 at least for the next couple of years, but there are whispers and rumors that they are taking a look at it. They're also taking a look at VantageScore, but they are taking a look at the new version of FICO for the mortgage industry. They're beta testing it right now to see if it will do what they want to do in the mortgage arena. And so, like I said, the ones you guys are using now are nearly 2 decades old. And FICO 8, the version before this, was supposed to be rolled out to the mortgage industry in 2008. But what happened in 2008? You know, so that was delayed for obvious reasons. But they're not going to adopt the new scoring model, and when Fannie and Freddie can't adopt the new scoring model until the entire industry is ready to take the leap, because everybody has to migrate over and move over at the same time. So even when they adopt it, it could take a couple of years to implement across the whole industry. Let's talk about errors in credit reporting. So we know that 79% of Americans have errors on their credit report. But there's this thing called the Fair Credit Reporting Act, or FCRA and FCRA. It was actually passed in 1970. So Fair Credit Reporting Act's been around for what, almost 50 years. And during this whole time that we've had it, it's supposed to be helping protect us as consumers against inaccurate, outdated, unverifiable, obsolete information being reported on our credit reports. But here we are 50 years later, and 79% of Americans still have errors on their credit report. And we're not talking about bad credit. We're talking about errors through no fault of their own. And, when millions of records are exchanging hands on a daily basis, errors are going to happen. That's just the law of averages. It's the nature of the game. And most errors aren't malicious. Usually there's not somebody intentionally trying to harm a consumer or hurt an individual by reporting an error on their credit report. Mostly it's data entry mistakes. They're typing too fast. They transpose the last two of a social security number. They have 10 customers named John Smith. They apply the payment to the wrong one. Maybe they hit a junior instead of a senior on a drop-down menu. These are how errors happen. And the problem with the bureaus isn't that errors happen. To fix once they do happen. I don't know if you've ever tried to fix an error on a credit report yourself or had a consumer that did so, but it's very, very difficult. It's obviously the reason we are in business. And that goes back to what we talked about earlier. The credit bureaus are not consumer-driven organizations. They're not set up to resolve these type of issues for consumers. So you have the situations where errors happen, and sometimes it can take years to fix on a credit report. And these errors have real-world cost. If 79% of Americans have errors on their credit report, they estimate that about 20% of Americans have errors on their credit report that are so severe that they can either not obtain lending or they can't get the best rates and terms. That's 60 million people who are somehow being impacted in the pocketbook by not getting the best rates and terms or not getting approved for credit when they should be, because it's not a true reflection of their credit report. Because the errors are there, and again, they're through no fault of their own. So there's some major changes. There's been a lot of, with the CFPB and other regulatory bodies, there's been a lot of push and pressure started to be put on the bureaus in the last several years. One of them is the National Consumer Assistance Plan. I'm not sure how many of you guys have heard of this, but this actually came about in 2016 and 17. And it's not regulatory, it's not legislative, it wasn't a mandate or a law that passed. What it is, it's actually a settlement that came out of a lawsuit from the state of New York versus the 3 credit bureaus. And so what happened was, as a part of that settlement, these are changes that the 3 credit bureaus agreed to make in return for, not being, continue to be sued by all these different states. The biggest one is public records, right? I mean, I think most of you guys are aware or have heard that public records would no longer be reported on credit reports. And the original date for that was supposed to be, the summer of 2017, but they had a year to implement it. So really it didn't take effect until about May of 2018. And they estimated that 100% of tax liens would no longer be on credit report, and about 50% of civil judgments would no longer be on credit reports. What ended up happening, though, is that we never see any public records on credit reports anymore unless it's a bankruptcy. We don't see federal tax liens or civil judgments at all on credit reports anymore. And the reason for that is the bureaus just got scared into not reporting them anymore because of all these lawsuits, because some of them were being reported in error, and that's why they were being sued. Most of them are not errors, but the consequence is this. Now that public records are no longer being reported on credit reports, or civil judgments and tax liens anyway, those no longer affect the consumer's credit score. So it's very possible you could have a borrower with a $40,000 tax lien, but it's not on their report, so it's not affecting their score. Now, that being said, it's still in CAIVRS, or it's still, in some product that you guys are probably using. What happened was, once they quit reporting on credit reports, the mortgage industry adapted really quick. They're like, oh, okay, well, if it's not going to show on the body of a credit report and it's not going to affect their score, we need to at least know if they have these things out there, because we can't write a loan for somebody with a tax lien or civil judgment that's unpaid. So, oftentimes it'll show up in CAIVRS, but a lot of our mortgage partners have other products like Loan Guard or Loan Safe, these different products that you use to search for public records. But what this has caused is a lot of consumers to not disclose it, right? So if you're filling out a mortgage application and you just looked at your credit report last week and you didn't see that tax lien on there, are you as a consumer going to be honest and put on a mortgage application that you have a tax lien? A lot of them are not, and they think since it's not shown on the credit report that you're not going to know about it. But the reality is that a lot of them don't know that you're going to run a CAIVRS report or another public records search, and you're going to end up seeing it. So that's become more common, where our mortgage partners are seeing public records that are not disclosed because consumers are aware that they're no longer on the report. Some of the other changes in the National Consumer Assistance Plan is that there's enhanced dispute process for ID theft and fraud. And one of the big things that came out of that is that if you remember, it was always a really big thing, a real big pain in the butt for consumers to put their credit on freeze or unfreeze their credit. And it was a nightmare as a loan officer if you had a consumer come to you and they had forgot they put their credit on freeze and you're trying to pull a mortgage application and you can't because their credit is frozen, and then they can't find their PIN number. They don't know how to unfreeze their credit, and sometimes it would take weeks to get through that process. Well, they've changed a lot of the laws. Now it's free for you as a consumer to freeze your credit, and it's free for you to unfreeze your credit. And all three bureaus have mobile apps now, so you can download a mobile app from all three credit bureaus and freeze and unfreeze your credit with a touch of a button on your phone. So now, if I wanted to, I could have my credit frozen, go sit in a chair at a mortgage office, and unfreeze my credit 30 seconds before a loan officer pulls it, and it's going to be unfrozen. It's real time. So this makes it a lot more convenient for consumers to keep their credit frozen, or for you to keep your credit frozen and not have to worry about the hassle of either paying for it or the nightmare of unfreezing it when you want to go apply for something. Because as you know, when your credit's frozen, not only can a credit, not even you can use your credit. Nobody can use your credit. It's completely frozen. So the other biggest change was in regards to medical bills. There's a 180-day cooling off period now for medical bills to be sent to collections. So that means from 180 days from the invoice or bill date for a medical service, they cannot send to a third-party debt collector. They need to give you either 6 months to pay it, or for you to be able to get your insurance to pay it. Now, everything in the credit world is the way it's supposed to be and the way it actually works. So, you know, a lot of medical collection companies and doctors and hospitals and people who deal in this arena don't even know about these law changes. So this is the way it's supposed to be, but every day we're seeing medical bills hit the credit report after a month or be illegally reported. So, you know, I think eventually in the long term, this is going to help, but right now, you know, it hasn't made much difference yet. The other big change is medical bills must be deleted if they have been paid or are being paid by insurance. So there is recourse now for a consumer to go back and get those medical bills off their credit report if they can prove that they've paid it or the insurance has paid it. This is a big change because previously paying medical bills, obviously, and we all know on this phone that paying collections doesn't ever help the credit score. But if they're willing to delete an item off the credit report, then obviously that changes the game, right? Then there's more incentive to go back and pay that medical bill or make sure your insurance covered it, because then now it'll be removed from the credit report. And the other big change is debts that do not originate from a contractual agreement. So what would those be? Parking tickets. Believe it or not, here in Dallas-Fort Worth, we see consumers all the time with City of Dallas parking tickets on their credit report. Dog groomer, hair salon. It had gotten to the point where anybody could put anything on your credit and not have to have a contractual relationship with you. All they had to do is believe that you owed them a debt, and they could go to a collection company, contract them to report it to your credit bureaus, and all of a sudden it's on your credit report. So you may have a dispute with a vendor or a retailer or anybody, and their resources, they could slap it on your credit report. That's not supposed to be the case. You're not supposed to be able to have, you know, vet bills and parking tickets and things like that on your credit report. So we should see a lot of those start to disappear over time. But if you want to, you can go to the National Consumer Assistance Plan website. It's right there on the bottom of the screen, and it details all of these changes and many more that should help consumers in regards to the way the credit bureaus treat these type of items and other items on their credit report. I'm going to talk about online disputing for a minute. You know, when we work with mortgage partners, and I ask this question all the time, but if 6, 7, 8 years ago you were a mortgage person and you pulled a credit report and you saw a bunch of disputes on the credit report, what would you think? Most mortgage people I talk to would say, oh, if I saw a bunch of disputes on a credit report, I could be pretty sure that they went to credit repair or they're in credit repair. And that was the case back then. But with the advent of Credit Karma and many of these other credit monitoring websites, and even the bureaus themselves on their website, are encouraging consumers to dispute mistakes on their credit report. The problem is the consumers aren't disputing real mistakes or documentable errors on their credit report. What they're doing is they're going on the app on Credit Karma, or they're going to a bureau website, and they're disputing every negative item on their credit report, every collection, every late payment, every negative mark they've ever had, they're disputing it. And I don't blame them. You know, they're disputing this negative stuff. Somebody's saying, hey, dispute right here. The problem with it is that when you dispute stuff online through these sites, you waive a lot of your rights under the Fair Credit Reporting Act. You lose the ability to go back and address some of these issues later. And so unless you have documentable proof that it's an error and you're just disputing it to dispute it, which is what most consumers are doing, it actually causes more harm than good, because even though some of these things may get deleted in the short term, as soon as those creditors go back and re-verify that information or re-upload it to the bureaus, now it's right back on the credit report. But what has happened? Now it's got a newer date. It was reinserted at a later date with an updated date, an updated open date, an updated, date of last activity. Now it's got a newer date on it once it's put back on the credit report, and it actually makes their score go down. So for these reasons, online disputing is really bad. We don't want consumers to dispute stuff themselves online. If they are going to dispute something, they should always dispute it through written correspondence and certified mail, just like we do for our customers. Online disputing causes a lot of ill side effects if not done properly. And that's what you're seeing. So now as a mortgage loan officer, when you pull a credit report and you see a bunch of disputes, you have no idea if they're in a professional credit repair program. They've just gone online and disputed everything themselves. There's no way of knowing because so many people are doing it. But in general, we highly encourage you to discourage consumers from disputing stuff online, especially if they don't have documentable proof and evidence that it's an error. So some common credit myths. Personal information can affect my score. We know that's not true, but a lot of consumers don't understand this. They think how much money's in their bank account could be affecting their score, their income, their employment. Nothing, no personal information has any bearing on score whatsoever. Not how long you've lived at an address, none of that. A third-party debt collector will remove that item from the credit report and or raise my score. These are the two most common things we get from consumers. Hey, I paid that. Why is it still on my credit report? Hey, I paid those. Why did my score go up? See, consumers view their credit reports as balance sheets, right? And that's not what a credit report is designed to be. A credit report is designed to be a reflection of credit worthiness and payment history over 7 to 10 years. If you could just go pay collections from last year and they would be deleted from your credit report, we wouldn't even need a credit scoring system, would we? We would just be able to hide the fact that we ever had bad credit by throwing money at it. And that's not what the credit system is designed to do. The credit system is designed to provide risk analysis for lenders that say, hey, if I lend you money, what are the chances you're going to pay me back? Well, if you didn't pay 6 people last year and got 6 collections on your report, that's probably valuable information. And you don't get bonus points for going and paying it a year or 2 or 3 years later, right? Balance in collections does not affect credit score. A paid collection and an unpaid collection are graded the exact same amount of points. The only thing that affects score in regards to the collections is whether it happened or not and the date it happened. So a lot of times consumers will ask that, hey, I paid that. Why is it still on my credit report? It's on your credit report because it happened, not because you paid it 3 years after it happened. So I want to encourage, and I want you guys to know that consumers need not look at their credit reports as balance sheet. The worst thing that somebody can usually do when they've been through a rough time in life, credit-wise, and this happens all the time, people go through a rough time, they get a better job, they're doing good, money is better, they want to go buy a house. They pull their credit report, they see all these old debts and collections on their credit report, and what do? They run out and they start paying a lot of this stuff. Well, that's counterproductive because we all know that throwing good money after bad money and paying a bunch of old stuff on your credit report is generally not going to help the credit score. So that is a common myth, and we want to always work with the consumers in a way that says, hey, if you're going to pay something, let's make sure we're paying something that is going to make a difference in the credit score or is going to provide you with, it's a requirement from the mortgage company to be paid so that you can get into a home loan. It's got to serve one of those two functions, okay? Checking my credit will hurt my score. We know this is a myth. Consumers ask all the time, if Credit Karma hurt my score, my FICO hurt my score, background check hurt my score, insurance. So the thing is that the only time that an inquiry is going to hurt your score is when you're applying for extension of credit. So an extension of credit would be a car, a house, a credit card. To be a mortgage loan officer, your licensing, even the car insurance companies, most car insurance companies that's not an extension of credit. So insurance inquiries are disregarded. And any self-initiation, whether it's Credit Karma, my FICO, your bank, anywhere you self-initiate to get a copy of your credit report is a soft inquiry. It's not a hard inquiry unless you're actually applying for approval for something. I'm going to give you guys the real deal on inquiries in a minute. But I think that the most common question I get amongst mortgage people is, what is the window, right? If I ask 10 loan officers, what's the window for deduplication on people applying for a mortgage, I'll get a bunch that say 15 days, a bunch that say 30 days, and a bunch that say 45 days. I'm going to give you guys the answer here in a second. Child support. I have this on here because it's not so much a myth as it's something really important for you guys to know. In the old mortgage scoring formula that you guys are still on, not in the new scoring formula, FICO 8 and FICO 9, but the mortgage scoring formula that you guys are currently using, child support does not affect credit score. So even if you see a consumer that has 120 days late on their child support, it's not affecting their credit score. I saw a file once where somebody had a 700 and something credit score and they were 120 days late on their child support. Well, how can that be? Well, in the old scoring formula, they failed to put child support in there. There's no 2-digit code for child support, which means it cannot be scored in the algorithm. So child support is disregarded in the scoring formula that you guys use. Now, the reason that most people don't notice it is because people who have bad child support or they're behind on child support usually have a lot of other bad things on their credit report. So their score is already low for those reasons. So it kind of masks it. But in that one instance that I saw where that child support was the only negative thing on his credit report, yeah, it didn't affect score and he was over a 700. So just keep that in mind. If you see child support on there, paying back child support or getting it caught up is not going to help the score because it's not currently hurting the score. That being said, we fully realize that you can't get a mortgage loan when you're behind on child support, or they got to prove that they're paying it. But the item itself is not actually affecting the score. The only caveat to that is that's the state reporting agency. So if the state of Oklahoma, state of Texas, Louisiana, whoever it is, if they're the one reporting it, it's not affecting score. If they sell it to a third-party collection company and it becomes a collection, then it would affect the score because then it's graded as a collection. We already talked about opt-out, but I don't know how long you guys have been in the mortgage business. I know some of you on the phone have been in the mortgage business for a little while, but when opt-out first became a thing 10, 12 years ago, there was a big rumor in the mortgage industry that having people opt out would actually raise their credit score. I can fully verify and tell you without a doubt that opting out does not affect credit score. And I still have a lot of mortgage people kind of, argue with me, butt up against me on that all the time. And I'm like, I'm just telling you guys, it can't. Opting out cannot affect credit score because there's no accommodation for it in the scoring system. There's no scoring factor for it, so it can't affect credit score. I think what mortgage lenders saw back in the day was, hey, a lot, people who opted out, tended to have less inquiries and less pre-screened offers coming their way, so they stayed out of trouble more. Maybe other things changed on their credit report, but opting out unequivocally will not raise your credit score, even though that was a myth back in the day. A lot of mortgage people would have all their people opting out thinking that would help the credit score. This is the old dreaded pie chart that I'm sure that you all have seen many, many times. You can see here, this is just 5 factors. Like when you talk about the algorithms for FICO, mortgage version, new versions, whatever they are, literally thousands of scoring factors go into these algorithms. And people always want to ask, well, what happens to my score if I do this? What happens to my score if I get a medical bill on my credit? Well, the answer is it depends. Is it your only medical bill, or do you have 9 others? Well, what happens to my score if I make a late payment on my mortgage? Well, I don't know. Have you made a late payment before? Where's your score? Are you a 750 or a 550? If you're a 550 and you make a late mortgage payment, maybe your score goes up, right? Because they're just happy that you paid it. If you're a 750, maybe your score goes down 100 points. And the point I'm getting at is that people want to tie specific actions to score increase or decrease, but you can't, because everything in the scoring formulas is built on thousands of factors. So, if A, then B, and if this, then that. And so the answer to every credit question in the world when it comes to score is it depends. It depends on what else is going on the credit report. But you can take all these thousands of scoring factors and you can break it down, and all of them are going to fit under one of these 5 categories. Obviously, payment history is the biggest, right? Are you paying your bills on time? Late payments are the biggest #1 drawdown on score, right? You make a 30-day late payment, a 60-day late payment, a 90-day late payment. That's always going to affect your score worse than anything else that could happen to your credit, is being currently late, right? You pull somebody's credit report, they're currently late on something. You're wondering why they're applying for a mortgage, but those recent lates are a huge score driver. They're the #1 score driver. And not coincidentally, they're the hardest things to fix on credit reports. I can't generally go to a consumer and fix a late payment on a mortgage they made last month that they really made late. So, recent late payments are deal killers. And the only thing that really helps recent late payments is time, right? Letting it age out a little bit, paying everything on time. So the 35% is paying your bills on time. The 30% is amounts owed. But I want to make sure you guys understand the amounts owed only applies to revolving, right? You are not penalized on installment credit for being wealthy. If someone has a $1 million mortgage and somebody else only has a $200,000 mortgage, but they're both being paid on time, the score is no different. The balance on installment counts. You're not penalized for having a $1 million mortgage as long as you can afford a $1 million mortgage and you pay it on time. So this 30%, and it's almost misleading because it's really not amounts owed either. It's percentage, right? It's utilization ratio. And let me give you an example. I know Colleen's on the phone with me, so let's pretend Colleen has 3 credit cards that are $50,000 limits, and all 3 credit cards that Colleen has, she has $10,000 balances. So she has $30,000 worth of debt. I have 3 credit cards that are $1,000 limit, but all 3 are maxed out. I only have $3,000 worth of debt. Colleen has 10 times as much debt as I do, $30,000 to $3,000. But her score's in the mid 700s because she's below 20%, and my scores are in the high 600s because I'm maxed out on all 3 cards. So really, it's not amounts owed, even though that's what it's labeled at on all pie charts that you see. It's really percentage, right? Your customers are always going to have the best credit score when their balances are below 20%. In the mortgage industry, they used to always say, hey, get all your cards down below 50%. And that was good advice. Raise the score a lot. And then it was like the 1/3 rule. So everybody says 30% now. So 30% or the 1/3 rule. Get all your credit cards down to that. And that's good advice too, because it raised the score more. But if you want to know the exact real percentage, it's 1 to 19%. 1 to 19% is always going to get you the best credit score on your balances. Okay. And that's across the aggregate. So that's not on each individual card, right? It's across the aggregate. So it's a total amount of your balances versus the total amount of your limits. But people confuse debt with credit. And I don't want you guys to confuse debt with credit. It's not about how much debt you have on your credit report. It's about how you service that debt and what percentage of available credit are you using. Length of credit is a big factor, 15%. So, the more accounts that you can keep for long periods of time, the higher your score is going to be. The more you churn accounts for points and miles and open and close stuff and get those inquiries, the lower your score is going to be. 10% is new credit. So you guys may have noticed, I know a lot of you guys probably know that when you buy a house or a car, when you add new debt, installment debt that has not been serviced, your score temporarily drops. So it's very common somebody buys a house or a car for their score to drop 20 or 30 points in the short term. Usually within about 6 months, that score is recovered and you're back to normal. But that's the reason. The more new credit you have, the bigger credit risk you are until you prove that you can pay that particular item. And then 10% is the types of credit used. Mainly 3 types of credit, right? You want to have all 3 boxes checked. There's the mortgage box, the installment box, and the revolving box. And to have the highest credit score, you need to have all 3 boxes checked. If I have a mortgage and 2 cars, but no credit cards, and you have a mortgage, 2 cars, and 3 credit cards, your score is going to be a lot higher because you have the revolving box checked and I don't. And the same with mortgage and installment. So to have the highest credit score, you always want to have all 3 boxes checked.
Interesting.
Inquiries. Huh? Your question? Okay, sorry about that. So inquiries. I told you guys I would tell you how this really works, right? We already went over the stuff at the bottom about soft inquiries. So here's the real deal when it comes to mortgage inquiries. Multiple inquiries are allowed within a 45-day window for like services. Mortgage is one of 3 like services. So when you shop for a mortgage, a car, or a student loan, those are considered like services. And you can shop for those things, and you can go to 27 car dealerships in 27 days, and that counts as 1 inquiry. You can go to 27 mortgage companies in 27 days, and that counts as 1 inquiry. Some mortgage people think it's 15, some think it's 45, some think it's 30. Here's the real answer. On 2 of the bureaus, it's 45. On TransUnion and Equifax, the window is 45 days on those versions of FICO for your consumer. On Experian, it's only 14 days, okay? So when a consumer asks you, well, how long do I have to apply with another mortgage company or to shop around for my mortgage? The answer is 45 days. It is only 14 days with that one bureau, Experian, but explaining that consumer is going to be very difficult, and it doesn't affect their mid-score. So how you want to address that is up to you. The one bureau is 14 days. The other 2 is 45. Most of my loan officers just say 45. The window is 45 days for mortgages. For cars and student loans, it's all 45 because they're all in the newer versions of FICO, which are all 45. They want to give people time, and it should be the right of the consumer to shop for the best rates and terms and not be penalized. That's why deduplication takes place, and that's what it's called. When you're shopping for like services and a multiple of inquiries only count as 1 inquiry, that's called deduplication. And in the old version, FICO 2 that Experian's on, it's only 14 days. Every other mortgage, the other 2 bureaus, every other mortgage, and every other thing you're shopping for is always going to be 45 days. Now, it doesn't apply to credit cards and retail accounts and banks and loans and stuff like that. It only applies to car, auto pool, mortgage, and student loans. We already talked about utilization ratio. We just talked about it. But balances are a huge score driver. I mean, balances can be the difference between 40, 50, 60 points on a credit report. All things being equal, it's the difference between 740 and 680 if it's just balances that are maxed out. So that ratio across the aggregate, all open and just revolving, all revolving accounts for the best credit score should be 1 to 19%. Okay. Now there's different ways to affect utilization rate. You know, you can pay down balances, but you can also get limit increases, and that lowers your utilization rate because you have more available credit. And I'm going to talk about trended data for a second because that really affects you guys in the mortgage industry. It's not affecting you yet, but it will. I mean, I know that on mortgage credit reports now, trended data on certain types of accounts are required to be on the mortgage report. So mortgage reports look a lot different now than they did 5 years ago because of trended data. So now you'll see the payment history, the balance, how much they paid, did they pay the minimum, what the payment was that particular month, and you can see that going back to 12, 24 months on a lot of accounts. That's called trended data. They're giving you the trended data on that mortgage report. It makes 0 difference to you as a loan officer and 0 difference to the consumer because nobody is making underwriting decisions on trended data yet. They see it, it's on the mortgage report, but I haven't heard of somebody losing a mortgage loan because of trended data. It doesn't affect score. Trended data does not affect score yet. Will mortgage companies start using trended data to make a decision on whether to approve somebody for a loan, all things being equal, even if they have a qualifying credit score? Nobody knows yet. They haven't really done anything with it. The actual FICO scoring models do not use trended data in the scoring formula. Even FICO 9, the latest version, doesn't use trended data in the actual scoring of the report. So right now, the only thing that counts on a credit report is what is your balance the day they pull the credit report. But there is talk from FICO that in future scoring models that you will be actually credit scored on trended data. And the mortgage industry wants it to go that way. And the reason is this, because if your cards are maxed out for 24 months and me or a loan officer or somebody tells you pay these 3 cards down below 20% and your score goes up 60 points and then you max them out next month and your score goes back down 60 points, is that truly a reflection of your credit score or where you're at or how you manage your credit? No. And this is the difference between being a revolver and a transactor. Month or historically keeps their balances very low at all times. A revolver is somebody whose credit cards are most of the time maxed out or above 80%. They're carrying big balances all the time. They're making the minimum payment every month. They're one paycheck away from not being able to make that minimum payment. They're maxed out on multiple revolving accounts. The difference between a revolver and a transactor in mortgage default rates is 7 to 1. All other factors, score and everything else, all other factors being equal, a revolver is 7 more times likely to default on a mortgage than a transactor. And that's why they're moving that direction. That's why they want to know how their balances, how they've managed over 2 years, not just they paid down some credit cards last month to pop their score up 50 points and hide the fact that they're always maxed out. So you guys will see trended data coming down the pipe a lot more. I don't know if any of you guys have heard pay for delete, but I told you guys earlier that we all know that paying collections does not raise the credit score. The act of paying a collection itself is never going to raise the score 1 point, and it's never going to take that item off of the credit report. The act of paying a collection is not a legal reason for something to be removed from the credit report. That being said, if a collection company is willing to take it off your credit report, then it would be worth paying, right? This is called pay for delete. This is something that's been, in the market for 3 or 4 years. Loan officers have started telling their clients, hey, call that collection company, offer to pay them, see if they'll delete it from your credit report. I just want to warn you guys that it's a good strategy, but it needs to be used really judiciously, right? If somebody has a bunch of collections, you don't want to tell them to go do pay for delete. Because some collection companies will do it and some won't. So they'll go spend hundreds or thousands of dollars doing pay for delete on collections and not get the score they need because the other half of their collections won't do pay for delete. Pay for delete really should only be used when you have that client that has 1 or 2 very recent collections and not much else wrong with their credit. Or you know that 1 or 2 recent collections is driving the score 30, 40, 50, 60 points and you need 20, right? Anytime you ask a consumer to spend money in lieu of their credit score going up or home loan approval and it doesn't work out, guess who they're going to blame? So if you're unsure, you can always call us and ask us, have us take a look at something, see if it's a good candidate for a specific action. But if you are going to instruct a consumer to do pay for delete, you need to make sure you instruct them to do it the right way, okay? Only about 30 to 50% of collection companies will currently do a pay for delete because technically they're not supposed to. Technically, they're not supposed to delete something from a credit report just because somebody pays it, because that's kind of a manipulation of the system. It's in their contract with the bureaus. But they want money, so they do it. A lot of the smaller, not so known collection companies, medical collection companies, those are the companies you see doing it the most. Maybe some utility collectors. The ones that are collecting for auto repos and credit cards are not doing pay for delete, okay? The catch on pay for delete is it's got to be paid in full. So if you call ABC Medical Collection Company and say, hey, I'll pay that $450 medical bill, but only if you delete it from my credit report, okay? They have to use the terminology pay for delete. They have to pay it in full because that's a requirement of the collector to do a pay for delete. And they must get proof from the collection company that it's going to be deleted or removed from all 3 of the credit reporting agencies or bureaus before they pay it. That means they need to get a deletion letter, and that deletion letter needs to have the name of the account number, and the verbiage removed or deleted from all 3 credit bureaus or credit reporting agencies. That's the only way I would do a pay for delete. Otherwise, they get amnesia. right? You pay them, oh yeah, we were going to delete that, and you don't have a letter, you don't have proof, and it's your word against theirs, and you're just paying them, and it's not going to be deleted. And again, the act of paying it itself is not going to take it off. So now they update the collection is paid, they update the date of last activity. It could lower your score, it doesn't help. And showing a collection paid on a credit report does not change the score. Just like pay for delete, there's this thing called goodwill deletion. I know I'm running up against it at 2 o'clock. We got started a little bit late. I'm going to try to wrap as quick as I can, guys. But goodwill deletion is the same thing as pay for delete, except it's for the singular instance of late payment. So you have that borrower, they made a late payment on their car 4 months ago. It's been open for 4 years. It's the only late payment they've made. They can call the creditor and ask for a goodwill deletion. And by the way, it happens. It works about half the time. It's very effective. I've even seen people do it on mortgage lates. I saw somebody do it on a mortgage late with Wells Fargo. They were a Wells Fargo customer for 12 years, made one late mortgage payment, and they were able to convince them to do a goodwill deletion. So it's for that single instance of recent late payment with an original creditor, not a collection company, but you have a car, a credit card, or a house, you go on vacation, something slips through the cracks, you make that late payment. It's the only one you have. You've been a customer for several years. So it works better for accounts that have been open for a longer period of time. And they need to use that specific terminology. And they got to speak with somebody in the credit department. You can't do a goodwill deletion by calling Capital One's customer service line. You know, you call there and then you ask to speak with somebody in the credit department who can actually affect credit reporting and get them to agree to do a goodwill deletion. And a lot of times they'll do it. They'll delete that late payment, that singular instance of late payment off. And you're basically just asking them to do you a favor and say, hey, you know what, as a valued customer, you know, I've been with you for 4 years. I never made a late payment. This was an oversight on my part. You're just basically asking them to do you a solid favor, you know? And a lot of times they will if you're a longstanding customer and it's not a history. Now, if you call Capital One and ask them to delete a late payment from 3 months ago on a goodwill deletion and you made 4 late payments last year, they're not going to do it, right? So it only works in those instances. But again, they need to try to get a letter. They might not do it in this instance, and it's still obviously, you know, they say they're going to do it. It's good for you. You might not be able to get documentation. The point of the documentation, whether it's a deletion letter or a letter from them saying they're willing to do a goodwill deletion, is to allow the mortgage person to do a rapid rescore. But if you can't get the letter, then you kind of just have to wait for it to update, which can take 30 to 45 days. Authorized user account still work as good as they ever have, guys. You know, there was a lot of rumors in the mortgage industry that authorized user was going away in 2008. And in the newer versions of FICO, FICO 8 and FICO 9, they have taken some of the benefit authorized user out. In the old scoring formula that you guys are still on, it's as good as it ever was. You know, so, you know, you can get big score boost if your client has a thin credit file, or even if they have 3 credit cards because they're trying to reestablish credit after a bankruptcy or after a rough time, but all 3 credit cards were open in the last year. That's thin. If they can get an authorized user of a parent or a sibling or a spouse that's been open for 10 or 12 years, and they get that history, that's the trick. That's what makes the score go up. It's that history, not having a 4th account instead of a 3rd. Now the average age of those 4 accounts goes to 3 years, not less than a year, right? On the 3 accounts. So authorized user is still a great thing to do, but it really needs to be with a family member. If you have a client that does an authorized user outside of a spouse, parent, or sibling, it could be mortgage fraud. There are companies out there with websites selling trade lines to strangers. So as a consumer, you can go to a website and get on some guy in Florida's 2 Amex card that's been retired for 30 years with $50,000 limits, boost your score 60 points, go apply for a mortgage. They take you off next month, your score goes down 50, 60 points, and now you've just committed mortgage fraud. There really is no repercussion for the consumer, but if a mortgage loan officer, a realtor, or me, or you know, if somebody involved in that transaction knows that, and that's called piggybacking, and if they know that a consumer's piggybacking off a stranger's trade lines, and they find out about it, you know, people go to jail for that. That's pure and unadulterated mortgage fraud. So if they are going to do authorized user, it's perfectly legal, it's perfectly ethical, it just needs to be with a family member. I just talked about that, piggybacking. And these are the rules of authorized user. Needs to be an account that's been open 5 years or longer. The higher the limit, the better, because that could free up some utilization space if they've got some balance issues. It needs to be an account that has less than 20% balance, because we don't want to add balance issues. And then needs to be an account that's in good standing and never paid late. And you really need to do it with somebody you trust. That's another reason it's good to do it with a spouse or a parent that you know is not going to make a late payment, because you live by the sword and you die by the sword. So if you get all that history and your score goes up 40, 50 points, but they max out the card and make a late payment, guess what? Your score is going to go back down, and it could be worse with a late payment. And once you're on as an authorized user, you're on. So even if you take yourself as an authorized user off of that card, the history still stays on the credit report. Okay? So you're getting the history, but you also get any ill side effects if they happen. Building credit, thin files, secured credit cards are a good starting point, not more than 2. I have a lot of mortgage partners. They'll tell people go out, open 3, 4, 5. Not more than 2. Doesn't help. Once you get past, at that point, it's more about the length of history and the balances and stuff. 2 secured cards are enough. 2 secured cards are enough. I always suggest that they get, 1 in their own name. If they need to do an authorized user, that's cool. Or they can do 2 secured cards and an authorized user. That's the quickest way to generate a boost in score. They want to get a higher limit, unsecured revolving lines of credit. A CD secured loan or savings account they can get from their bank. That would be installment credit, so they can build some installment credit. I always recommend 2 revolving, 1 installment. So when somebody has a blank slate, they have no credit, or they're recovering after bankruptcy, or they just went through a rough time and they haven't reestablished, 2 revolving, 1 installment. They can do a CD secured loan and a couple secured cards, or 1 secured card, 1 authorized user, 1 CD secured loan. But they need that good mix of credit. So we want the installment box checked and the revolving box checked. But I always start with 3 open trade lines as a base for rebuilding, okay? I get requests from loan officers all the time with people with no scores, right? You see those credit reports and they say file not scored due to insufficient data, or they got a score on 1 bureau but not the other 2. To report a score, you must have at least 1 open trade line that's been reporting within the last 6 months. That means if you haven't had credit for at least 6 months, you haven't had anything in the prior 6 months, and you have no score, then it will take up to 6 months to report a new score, right? So you can go open 5 secured cards or 10. It doesn't matter how many you get. That first one has to be open for 6 months in a lot of cases before you'll generate a new score, okay? That's why I like to use authorized user, because I can get them into a secured card in their own name to rebuild their credit, but then we can try to do the authorized user to get that history to report a score quicker, okay? And you cannot be reporting as deceased. If you're reporting as deceased, then you cannot have a score no matter how much good credit you have on there. And again, we see that all the time where you pull somebody's credit and it shows that they're deceased when they're sitting right in front of you and they're very much alive. FICO score models look for length and depth of credit, okay? That's the key, length and depth. And I'll just run through student loans real quick. Total student loan debt equals $1.56 trillion. 8 years ago, it was $300 million. So we've increased by 5-fold in the last 8 years. It's the next big American problem. It could delay home ownership for a generation of people. 44.7 million U.S. borrowers have student loan debt. Almost, I think about 33% of them are either in default or currently paying late. 5.1 million in default, another 10 million currently paying late, and they estimate in the next 2 years that number will be over 50%. Over 50% of all U.S. student loan holders will be either in default or paying late, out of 44.7 million people. Imagine that. 22 million people paying late or in default. And you know what? A lot of these people are like, they don't worry about it. They go in deferment after deferment, income-based repayment programs. Forgiveness is coming. We got all the, Obama repayment programs, student loan forgiveness. Right now, out of 44.7 million, only just a shade under 900,000 are even eligible for forgiveness, public service forgiveness. They've only received 50,000 applications, and only 423 people to this date have actually been forgiven of their student loans. So, I mean, 20 times that number think they're going to be forgiven. They don't know that they're not eligible, right? So they're in for a real shock when their deferments run out, all that interest capitalizes. It's just going to be a big, big mess. The average amount of student loan debt increases $2,000 for each graduating class. Student loan debt exceeds all credit card and auto loan debt in the U.S. combined. Imagine that. Federal government made over $50 billion in student loan repayment last year, and that's with a third of the people not paying. That's more than ExxonMobil. ExxonMobil was the most profitable company in the U.S. last year. They edged out ExxonMobil by $1 billion. The average length of repayment for student loan borrowers is 21 years. And like I said, it could delay home ownership for a generation of borrowers, mainly for DTI reasons, right? Because when you have a lot of student loans that are on 20 and 30-year repayment, what is that called? That's a mortgage. Now you got to qualify for a second mortgage to get into a house. So it's a tough scenario. We have student loan solutions here at Rising Point. If you have a borrower that's in default, we can get them in a rehab program. Now, usually people with defaulted student loans have a lot of other bad credit, so they probably need credit repair too. But if you have borrowers with good credit and it's a DTI issue, we could potentially help there too. We can reduce the amount of hit that you have to take on FHA loans at 1% on DTI, usually down to about 60%. So about 0.6%. So for every 1,000, we can usually shave off about a $400 of student loan on their DTI. And it's still a fully amortized payment. It's just a consolidated different payment plan that they were on before. If you guys have any questions about that, you can reach out to us. Anyway, I appreciate you guys taking the time with us today. I'll answer any questions if you guys have it. Rising Point Solutions is my company. We're a credit restoration company based out of DFW. I have the A team on the phone with me, Amanda and Allison. They work with all of our mortgage partners in Oklahoma. We will be in Oklahoma tomorrow through Friday, Wednesday, Thursday, and Friday. I'll be in Oklahoma. We have a big happy hour on Thursday night. We've invited pretty much all the mortgage and real estate people in town, so it should be huge. We have, I think, 12 sponsors for it. It'll be a big real estate mixer on Thursday night. Natalie, when she sends the PowerPoint or the recorded webinar or the PowerPoint presentation I did out to you guys, we can include a flyer for our happy hour. But we'd love to meet you guys and see you if we haven't before. And we'd love to work with you, with your customers if you have clients that may need help with credit or student loan issues. We have a lot of unique resources. We have rent reporting, student loan solutions, installment credit and credit cards that we can get your clients into, even with people with bad credit, vetted resources. You can find all those at risingpointsolutions.com, which is our website. There's a resource tab where you can find credit cards, lines of credit, installment credit, credit monitoring, and rent reporting solutions. So you'll have that website for your reference. Does anybody have any questions about credit and any of the stuff I went over today? I do have a question, a couple questions that I'll answer real quick that came through on chat. Oh, that's not a question. We will send you the PowerPoint though. I recently saw a credit report that had added themselves to a parent's card as an authorized user. The creditor did not give them credit for the full length of the loan, just the time that they had it. Is that normal? That is not normal. And I haven't seen that specific circumstance, although I have heard of it happening before. And I don't know if this will answer your question, but it's really, really important when you're added as an authorized user that they understand that you're adding them as an authorized user and that they collect that social security number to be able to report it to the credit, although that doesn't sound like that's the issue. I don't know why they would only report from that point forward unless they ran them as a jointly responsible and made them a signer on the card. But the answer to your question is it's not normal, and 9 times out of 10, when we have somebody do an authorized user, it reports the full length of the history. That's the whole point, and that's the whole trick. Otherwise, they could just open their credit card, their own credit card. Does anybody else have any questions? Either by voice, by speaking, or chat? All right. Well, I appreciate Dawn, Georgia, Colleen, and Brooke, and anybody else that was on the webinar today. Sorry for any mix-up in time or link to log in. We'll try to be smoother on our next one. We'll probably do another webinar up for all of our partners up there in a couple months. I'll probably try to bring some new content to that webinar outside of what we went over today. But if you guys have any questions, you can email us. Natalie will send you either a recorded version of this webinar and or the PowerPoint, and we will look forward to seeing or meeting all of you when we're up there. All right, guys, everybody have a great day, and we'll look forward to talking to you soon.
Thanks so much.
Thank you.